The advent of cryptocurrencies has revolutionized the financial landscape, prompting not only individual investors but also institutional entities to explore the potential benefits and risks associated with digital assets. As the market matures, institutional adoption of cryptocurrencies has gained significant traction, driven by a combination of technological advancements, regulatory developments, and evolving investor sentiment. This essay will explore the factors contributing to the institutional adoption of cryptocurrencies, the current state of the market, challenges faced, and future prospects. The rise of institutional interest. Historical context. The early years of Bitcoin and other cryptocurrencies were characterized by skepticism and speculation. Initially perceived as a tool for illicit activities, digital currencies struggled to gain legitimacy in traditional financial circles. However, the narrative began to shift around 2017 when Bitcoin experienced a meteoric rise in value, drawing the attention of both retail and institutional investors. The turning point came in 2020 and 2021 when several high-profile institutions, including MicroStrategy, Tesla, and Square, began to allocate significant portions of their treasury reserves to Bitcoin. This movement underscored a broader trend where institutional players started recognizing cryptocurrencies not merely as speculative assets, but as legitimate stores of value akin to gold. Factors driving adoption. Hedge against inflation. The global financial crisis and unprecedented monetary policies, such as quantitative easing, have led to concerns about inflation. Many institutions view cryptocurrencies, particularly Bitcoin, as a hedge against inflation. The fixed supply of Bitcoin, capped at 21 million coins, positions it as a deflationary asset that can preserve value over time. Diversification of portfolios. Institutions are increasingly diversifying their investment portfolios to include alternative assets. Cryptocurrencies offer a unique asset class that can provide uncorrelated returns compared to traditional equities and bonds. This diversification can potentially enhance risk-adjusted returns. Increased liquidity. The cryptocurrency market has matured, with numerous exchanges facilitating liquidity and enabling institutions to enter and exit positions more efficiently. The introduction of financial products like Bitcoin futures and exchange-traded funds, ETFs, has also improved accessibility for institutional investors. Technological innovation. Blockchain technology offers numerous advantages, such as transparency, security, and efficiency in transactions. Institutions are not only investing in cryptocurrencies, but also exploring blockchain applications to streamline operations and reduce costs. Regulatory clarity. The evolving regulatory landscape has provided greater clarity for institutional investors. Regulatory frameworks in jurisdictions like the US and Europe have started to legitimize cryptocurrencies, allowing institutions to engage with digital assets with more confidence. Current state of institutional adoption. Key players. Institutional interest in cryptocurrencies has led to the emergence of various players within the ecosystem, including asset managers, hedge funds, family offices, and even traditional banks. Major financial institutions such as Goldman Sachs, JP Morgan, and Fidelity have launched cryptocurrency-related services, from custodial solutions to trading platforms. Asset managers. Firms like Grayscale Investments and Bitwise Asset Management have developed cryptocurrency investment products that cater specifically to institutional investors. These products provide exposure to digital assets while mitigating some of the risks associated with direct investments. Hedge funds. A growing number of hedge funds are allocating a portion of their capital to cryptocurrencies. This trend reflects a broader acceptance of digital assets as a viable investment strategy, with some funds reporting substantial returns from their crypto investments. Banks and financial institutions. Traditional banks are increasingly entering the cryptocurrency space, offering services like custody, trading, and advisory for clients interested in digital assets. This institutional engagement has lent further legitimacy to cryptocurrencies and has helped bridge the gap between traditional finance and the crypto ecosystem. Adoption metrics. Various metrics indicate the increasing institutional adoption of cryptocurrencies. Assets under management, AUM. The total AUM in cryptocurrency investment products has seen exponential growth, with Grayscale alone managing over $50 billion in assets as of 2021. Institutional trading volume. Reports indicate that institutional trading volumes have risen significantly, with institutions accounting for a substantial percentage of total market trading volume. Surveys and studies. Surveys conducted by firms like Fidelity and POC reveal that a growing percentage of institutional investors are exploring or investing in cryptocurrencies. These studies show an increasing acceptance of digital assets among traditional financial entities. Challenges to institutional adoption. Despite the growing interest, several challenges hinder the full-scale institutional adoption of cryptocurrencies. Regulatory uncertainty. While regulatory clarity has improved, significant uncertainty remains in various jurisdictions. Institutions are wary of potential changes in regulations that could impact the legality and viability of cryptocurrencies. Security concerns. The cryptocurrency space has seen its share of hacks and security breaches. Institutions require robust security measures to protect their assets, which can be a barrier to entry for some. Volatility. The inherent volatility of cryptocurrencies poses risks for institutional investors accustomed to the relative stability of traditional assets. Price fluctuations can lead to significant losses, making risk management crucial. Lack of knowledge and expertise. Many institutions still lack the necessary expertise to navigate the complexities of the cryptocurrency market. This knowledge gap can hinder decision-making and slow down adoption. Reputation risk. Institutions are often concerned about the reputational risks associated with investing in cryptocurrencies, given their association with fraud and illicit activities in the past. Overcoming this stigma is essential for broader adoption. Future prospects. Evolving regulatory landscape. As the regulatory environment continues to evolve, it is expected that clearer guidelines will emerge, encouraging further institutional participation in the cryptocurrency market. Governments and regulatory bodies are recognizing the need to strike a balance between fostering innovation and ensuring consumer protection. Technological advancements. Technological advancements in blockchain and cryptocurrency infrastructure will likely continue to improve security, scalability, and usability. Innovations such as Layer 2 solutions and decentralized finance, DeFi, platforms are poised to enhance the functionality and attractiveness of cryptocurrencies for institutional investors. Integration with traditional finance. The integration of cryptocurrencies into traditional finance is likely to accelerate. As more financial institutions develop cryptocurrency-related products and services, the lines between digital and traditional assets will blur. This integration may pave the way for more sophisticated investment strategies that incorporate both asset classes. Education and awareness. As institutional interest in cryptocurrencies continues to grow, the imperative for education and awareness becomes increasingly pronounced. Institutions venture into the cryptocurrency space often encounter a landscape marked by complexity, volatility, and rapid change. Therefore, it is essential that firms provide comprehensive training and resources to help these institutions understand digital assets more fully. The role of educational initiatives. Educational initiatives can take many forms, from workshops and seminars to online courses and webinars. These programs should aim to demystify cryptocurrencies, covering fundamental concepts such as blockchain technology, the mechanics of trading, security practices, and regulatory considerations. Institutions must not only grasp the basic functionalities of cryptocurrencies, but also understand the broader economic implications and market dynamics at play. The institutional adoption of cryptocurrencies marks a significant shift in the financial landscape, driven by various factors such as inflation hedging, portfolio diversification, and technological innovation. While challenges remain, the current trajectory suggests that institutions are increasingly embracing digital assets as a legitimate investment class. As regulatory clarity improves and technological advancements continue, the future of institutional adoption in the cryptocurrency market appears promising. As the industry evolves, it will be essential for institutions to navigate the complexities of digital assets effectively, ensuring they can capitalize on the opportunities presented by this dynamic and transformative asset class.